Gold has breached $4,000 an ounce. But should we be concerned? On one hand, the gold investors are finally raking in the profits from the patience and due diligence through the brutal bear market of the 2010s. But on the other hand, could gold surge be signaling something far deeper? That the foundation of the global economy itself is cracking. So let's take a step back. According to the World Gold Council's September 2025 report, gold finished up 47% year to date. That is the strongest yearly return since 1979. That's not just impressive, that's historic. They also noted that gold made 39 all-time highs this year alone. And it wasn't just the precious yellow metals price action. Gold ETFs raked in $17.3 billion on the month. This is the largest monthly inflow ever recorded, and it was led by North American and European investors. So we're not just seeing price momentum, we are seeing capital migration. People are rotating their money out of fiat currencies that are losing value and placing it into a safe haven metal, which is gold. Now, why did this happen? The World Gold Council's gold return attribution model pointed to three major forces. Number one, political tension across multiple regions. Number two, the weakening of the US dollar. And number three is options market activity that amplified investor positioning. So these aren't isolated events, these are symptoms of fragility. When political uncertainty rises, when currencies weaken, and when volatility spikes, gold becomes the ultimate vote of no confidence. Now here's the twist. Even though gold has breached $4,000 an ounce and may seem overbought on a short-term basis, it is actually under-owned by many big institutions. That means that there's plenty dry powder on the sidelines and plenty of capital is parked into the broader equity markets. But we are seeing a major shift in the sentiment. So let's start with Morgan Stanley. Recently, the chief investment officer came out and said he recommends a 60-20-20 portfolio outside of the traditional 60-40 portfolio, which was 60% stocks and 40% bonds. Now he recommends that 20% be allocated to gold. Now that's 20% of your wealth allocated to gold. Historically, many people have recommended 5%. Now you have a chief investment officer of a huge firm saying that 20% of your capital should be allocated to gold. And his reasoning is that gold is a core inflation hedge and a volatility buffer. Then we've got another huge institution, BlackRock, coming out and saying that gold is favorable in a rate cutting environment. And lastly, we have Goldman Sachs, who had a $4,000 target on gold for 2025, which we have hit that target. They have raised their target for 2026 to about $5,000 an ounce. So while the mainstream financial industry once laughed at gold and called it a pet rock, they actually hit an about face and they are not laughing anymore. So here's the real question. Is gold in a bubble? Some may argue yes, the price is getting frothy and you may want to take profits. But looking at the longer term picture, gold's rise may not be in a bubble. It may just be a mirror reflecting a distorted economy where debt is at record highs, inflation remains sticky, and an artificial intelligence mania that has inflated tech valuations far beyond their fundamentals. Even as OpenAI's, better known as ChatGPT, CEO Sam Altman came out and said that AI is in a bubble. So if gold is rising while AI is peaking, we may just be seeing the money rotate from hype assets to hard assets. Now here's what the World Gold Council's analysts are warning about next. Even if gold cools off in the short term, its fundamentals remain intact. They note that during most equity drawdowns, gold still has positive upward movement, even when it started from overbought conditions. And even though the US dollar is technically oversold, that does not necessarily mean it is bearish for gold. In fact, in 2/3 of past market corrections, the dollar actually fell alongside stocks. This tells us something really powerful, that the market may not have a true safe haven left, except gold. So where does that leave us? We got central banks constantly buying a dip in gold, governments facing shutdowns and fiscal gridlocks, and investors slowly realizing that the paper gains aren't real wealth and that their purchasing power in dollars is eroding. So whether gold is at $4,000 or $5,000, it's not just about price, it's about trust. Trust in real money that you can hold and that preserves your purchasing power over the course of time. So in my opinion, gold is doing exactly what it was designed to do: exposing the cracks in the system, protection against the devaluation of fiat currencies, and reminding us all what real value looks like. So when you question if gold is in a bubble, you have to realize a couple of things. One thing is that when gold price rises, everything else around it is changing, not gold itself. The dollar is falling against gold. So that means that the purchasing power of your wealth in US dollars will not purchase you as much as it will today in the future. And gold serves as a hedge against that. So no matter what the price is today, for me, myself, I am still stacking gold. It's real money and it will preserve my purchasing power in the future, as it has done for the past 5,000 years. I hope that this is helpful, and I'll see you all in the next video.